John, we recently attended a breakfast that was hosted by Dan Iverson from PIMCO, the Group Chief Investment Officer, where he explained that over the course of last few years, where with a low interest rate environment, the risk on corporate bonds has really been rising. Can you explain a couple things? One, why that's happening, and two, what we've been doing to keep our clients' portfolios from insulating them from that risk?
Sure. So the corporate bond market we refer to as credit, right? There's different kinds of bonds, but that's a credit bond because you're reliant on a company's ability and willingness, et cetera, to pay back interest and principal on time. So the credit markets, we delineate, or we don't, Moody's, S&P, Duff & Phelps, a few others delineate and kind of help guide us through, different levels of credit for corporations. You go from AAA, highest, strongest ability to pay.
There's only, what, 3 or 4 companies now that
it's a small handful. AAA minus, AA plus, et cetera, on down to, you get to triple B. Triple B credit rating is what we consider the bottom rung of investment grade. So triple B all the way up to AAA. These are bonds that are just generally speaking expected to carry a reasonably low level of risk. There is a gulf, or there's a breach, but from triple B on down. So there's double B, et cetera, on down. Now, all these have pluses and minuses, so there's increments of each credit tranche, if you will. But once you breach triple B and you go into the double B area, now you're in high yield. So high yield goes by a couple different names, but perhaps the most derogatory is the junk bond market. Look, there's nothing wrong with high yield bonds. We've owned high yield bonds. There's high yield bonds in many portfolios. They're just a certain class of investment. They do carry higher risk. We're talking about companies with shallower balance sheets, companies that may be more economically sensitive, which would make the payment of interest more onerous. And therefore, they are at somewhat higher risk of default. And once you default on a bond, all kinds of bad things happen, both if you're the company that defaulted and if you're the bondholder that the company defaulted on.
Or the stock, if you're a stockholder in the bond.
True.
In the company as well.
True. Look, stocks and bonds, they both draw their strength from the economy, right? I mean, you pay bond interest out of earnings. Stocks are reliant on earnings as well. What Iverson was talking about was really, it's been over the course of the last 10 years. We've had this extraordinary low interest rate environment. The Fed has kept rates low 7 years at 0 to 25 basis points. And then very incrementally, and as we just mentioned, I mean, the rates are still low right now.
Right.
So this extraordinary period of low interest rates, if we consider the aggregate bond market, now let's talk about corporate bonds and leave out, treasuries and agencies and all that stuff. The aggregate bond market, triple B rated bonds, remember that that lowest tranche of investment grade, has gone from being about a third of the aggregate corporate bond debt outstanding to today it's about half. The implication, and that has happened because of low interest rates. I mean, companies have changed their capital structure. They've kind of come to the trough of low interest rates, if you will, and have fed for 10 years. And that money has, I think, energy is one sector that definitely has been impacted by that. Healthcare. But this money has found its way into the stock market quite often, either through M&A, mergers and acquisitions, or share buybacks. Whatever the reason, we have this big, enormous now chunk of our corporate credit that's triple B rated. The next step down from there,
it's teetering right
next step down from there is junk. So the implication, I think the significance of that is that, there are many players in the bond market, not just individuals, not just our clients, but you have foundations, you have endowments, you have pension plans, insurance companies that are all very reliant on credit, on the credit markets. And When do you see downgrades? When do you see defaults? When do you see more difficulty paying your interest? That tends to happen when you get into the late market cycle or really going into recessions. So we always expect downgrades in the market when you go from a strong economy to maybe a weaker economy. When a bond gets downgraded, let's say you go from A to triple B, or you go from double A to A, you're always going to expect an adjustment in the price because the bond now carries more risk. But when you go from triple B to maybe double B plus, you go from investment grade to junk, you all of a sudden, by investment policy statement, can't be held. You can't be held by many insurance companies, probably most insurance companies, many pension plans, or the level at which you hold this, junk bonds has to be much reduced.
Lower, yeah.
So you have really an immediate potential for an immediate dislocation in the bond market when you have all this selling pressure, potential selling pressure on triple B bonds to get out of this stuff. So that could be significant.
Okay, and we've been doing actively de-risking, if you want to call it that, our bond portfolios for
Been a couple years now.
Yeah.
So high yield, and this is a matter of record. It's been mentioned in several outlooks. High yield we eliminated as a discrete asset class, right? As a kind of a standalone fund or ETF, if you will. Almost 3 years ago, about 2.5 years ago anyway. Some of the more recent things that we've done was the reduction of floating rate senior loans, right, which is non-credit quality or non-rated or tends to be a lower credit quality. We've also added things. We added TIPS to our portfolios a couple of years ago. So it's not just been a reduction of some of these discrete standalone funds, it's been the addition of really risk-free credit into the portfolios. I would also add that we monitor and we communicate frequently with our portfolio managers to figure out what their credit profile is. And we have a pretty good idea of where, of who owns what. So our portfolios are not devoid of credit. I can't say that there's zero high yield in there, but they are, we have managed things to, with a serious eye on how much credit risk we are taking.